Today, we're going to talk about how land development can be less complicated, less risky, and more profitable than you might think. And I have with me Chris Porto. Chris is the founder and CEO of Smart Growth and Smart Growth Developer Academy in Oakland, California. Welcome to the show, Chris.
Thank you so much, Sam, for having me. I really appreciate it. I've heard a lot about you, and so I'm glad that we could finally connect.
Great. Yeah, thank you for joining us. So tell me, what are a few things our audience really needs to know about you right off the bat?
Well, I have only been in real estate for probably about 4 years now, and I started with zero experience whatsoever. I had a mission in my career to have a positive effect on society. So I started my whole career in consulting, focused on sustainability and climate change. I moved into solar energy development with a focus on finance, and yet I wanted to do more impactful projects that I could essentially go and experience myself and feel the impact that they were having on people's lives, and to try and make a dent in our collective movement forward. So I started Smart Growth with the intention of basically catalyzing sustainable development. And with that, named the company Smart Growth, primarily because it was a particular development philosophy that I was very drawn to, essentially focused on cities, focused on urban infill type of opportunities where you're kind of filling in the gaps and trying to orient towards transit corridors. So essentially it would promote a more walkable urban environment for people to thrive. So that was really my intention getting into it, and yet I needed a particular way to start in the process. And so, I jumped into one of these real estate investment programs, Fortune Builders, which you may have heard of, and essentially learned how to flip houses, realizing that was kind of the only way that was being marketed to me of how to actually make money in this business, and started doing that. And did about 8 flips in my first year, made some decent money, but was realizing that it wasn't quite the impact that I wanted to have. And so I had to put a lot of effort to learn the real estate development process, more generally speaking, to figure out how I could have a greater impact in line with my mission. Not only making money, but also creating impact in society.
And what were the first things you did then to shift from the residential single family type fix and flip into the development arena? What was that like? What was your first step? Because we talk about how it can be less complicated than one might think. So
yeah, that's a perfect question, because the transition I think was rather smooth, and I'm still in the process of transitioning, because development is unending. You can be a small scale developer, or you could be a multi-billion-dollar developer building the Salesforce Tower in San Francisco. So the sky's the limit. But my big realization in doing those single family homes was that I had to go through the zoning process on each and every one of those projects to even add a little bit of square footage, or to add bedrooms, or, there's basically rules written that govern what can be developed, what can be built. And so in that process, I just started to realize that zoning was actually the rules of the game. And so with that in mind, I just started diving deeper into the zoning code to understand what this whole thing was about, realizing that particular areas have already been allocated by the city for a higher density, essentially more units per square foot of lot area. And so, I basically started to look for development opportunities as opposed to just renovation opportunities, which is really what I was taught to do. I was taught to go after all the single family homes in a particular category, built in a particular point in time that needed some incremental improvement. But I wasn't taught about targeting development opportunities in higher density zones that can support a much greater number of units on that site, and started connecting with a bunch of architects and other professionals and city officials to figure out how to actually navigate the entitlement process. And so basically started finding opportunities that presented these various types of strategies to me, and kind of jumped full steam ahead. I basically took all the profits that I made from the single family fix and flips and invested almost all of it into one major development, which was a former gas station that was marketed on the market and could support up to 33 residential units on the site there. It was about 2 blocks to the BART station, and it could support ground floor retail, which was really kind of all of the key smart growth principles that I had been talking about. Residential on top of retail, very close to transit. Essentially, we tried to design the building to be net zero energy with a large scale solar array on top. And so it just seemed like I had to go all in if I wanted to make this transition. And, the other aspect of it was, because these entitlements would take a little bit longer, I had to modify the business model that I was operating under to continue to generate cash flow in the meantime. So I continued to market for the same type of deals that I was doing before, but was deciding to just pass them all off to other smaller scale fix and flip type of investors. So I was able to keep my cash flow relatively high by just passing on all those deals that I would have formerly wanted to do in the name of doing less deals, but deals that were more in line with the development opportunities that I was seeing.
Okay. Now, my experience as the developing that I've done in the past is there are a couple of things: patience with municipalities or city officials, and the process is really, I found, was really key, and being able to foresee, really plan ahead. And because so often the timing of the meetings, whether it's the planning and zoning or if it's a council meetings, whatever it is, there can be a lot of coordination. What in the process did you find to be like a key a component to being successful, to getting to that point, to getting to where you got the approvals that were required to make the project work?
Totally. I on this larger project, and I had taken on a few other projects that I felt like I could navigate myself, but this larger development, I decided to actually partner with a more experienced developer. So, and I've always kind of gone into any deal with this strategy of basically bringing the deal, getting it under contract myself, and then shopping it around for either partners or investors to actually pull it off. So in that same vein, I brought the deal to him. His name is Carlos Pizzola. He runs a company called BuildZig that focuses on entitlements. And he kind of came out of the planning commission world, working for the city of Oakland at the time. So I knew that I could partner with him. He would be bringing a lot of value to the table, and I could essentially go through the process with him to learn how to actually navigate it effectively, and take note of what pitfalls could potentially present to us. Now, the city that we were focusing on, Oakland, California, is a rather development-friendly jurisdiction. So, we didn't really receive much pushback in planning this. Eventually, it became a 41-unit project, as opposed to just a 33-unit project, because we enacted a state bonus density to actually get even a greater unit count. But we knew that the city would be relatively supportive of the project that we were doing, especially because it was in an area that was not as litigious as some of the other areas are in Oakland. Oakland is a very big city. And so, with all of those things in mind, we kind of put together a risk profile for the opportunity. And just to also say that, the project that we were planning was within the zoning code. So the zoning code had already basically stated that we could get approvals for that, quote unquote, by right.
So it didn't require any zoning changes, which is one of the bigger steps within any development process.
Correct. And not only did it not require a zoning change, which would typically be like a major variance that would go up to the city council, this was an administrative level approval. So in the way that the code is written in Oakland, and every city is different, the approval hierarchy that was defined was basically an administrative level process. So we wouldn't have to even go to the planning commission, because the city of Oakland has empowered its planning, its professional planners to have enough discretion where they can actually make approvals without triggering a higher, more publicly oriented approval.
Wow. So that to me sounds like it's a huge lowering of a hurdle by being able to go through that sort of an administrative process versus going through the entire entitlement standard process.
Absolutely.
So that obviously is one of the ways to keep it less complicated and less confusing is to find municipalities, cities that or governing bodies that are friendly to developers or to the process of developing. And the other one that I really like that you said was the being able to team up with someone who's already done it. And I'm always a very big advocate of collaboration and working together and teaming up with people. And to me, that's just one of the best ways to leverage into something and get in with less complications, less risk, and really be able to do some amazing things with that.
Right. And it can be the most rewarding type of learning experience because you can get paid very handsomely for doing it.
Absolutely.
Right? If you trust the people that you're working with and you understand that they know how to navigate it, you can kind of go along for the ride, whether you're an active participant, right, as a manager who's bringing some experience to the table, or you're even a passive investor who wants to actually participate and invest in a development project to understand how to navigate it and essentially take that learning and the returns that you've made and do it in your local area. That the thing with entitlements is that people who are on the ground in a particular city are actually the best positioned to actually create value in that area, because you can kind of understand the lay of the land and pitch to other people that, look, you understand how this city works, and that local knowledge is really, you can't really replace that. So I think everybody has a unique opportunity if you get to know your city in a deeper way, and specifically the zoning code and how the city actually interprets the code, because there can be a discrepancy there as well. The code could say one thing, but the people who are in control could be actually not following the rules as they're defined.
Okay, so we get a piece of raw land, we get it to the point of where it is entitled or has the approvals so that the property can be built on. Can you talk a little bit about the stages? Because there's obviously stages within that portion of it, but there's also stages past that. Could you just talk about that?
Yeah, for sure. So, in what I learned, and I went through a lot of training with the Urban Land Institute, ULI. They were kind of the best source for information. It's kind of the global association for real estate developers. And so I was kind of learning stuff on a more academic level, but they're the group that's essentially writing the textbooks on real estate development for universities. And so what I took out of that was really understanding the development process and how there's three kind of real distinct phases in that process. It's the entitlement phase, then it's the building construction phase, and then the operations phase for the commercial real estate. And when we talk about commercial real estate, it's really income property. It's
so it could be it could be apartments, it could be even rental.
Yep, or office or retail. Anything that has an income stream to it, because essentially, in commercial real estate, it's all based upon the net operating income, and then capitalizing that to get to a valuation, because different income streams have different risk profiles, and that's really how that whole world works. And in my mind, it's actually much more predictable, because you're looking at the collective asset class in a particular area and saying people are willing to pay that much for that type of income stream. So, realizing that going through this whole process and essentially getting the entitlements to build something in particular that will then result in a particular income stream is really the whole exercise, and they're intricately linked. So what I started doing, and my background is in finance and financial modeling and how to actually predict out into the future particular returns from an opportunity. And so realizing that I need to basically predict all the way to the end when the building is completely stabilized, generating a certain amount of net operating income. And then I need to basically back out to figure out how much it's going to cost me to get there, what the total costs are, including hard costs and soft costs and buying costs, holding costs, financing costs, and the land costs. And so really the way that land entitlements are valued is really backing out what a developer can pay, for example, for that entitlement site in order to still hit their target return. And in this business, everybody uses a yield on cost metric. What's the net operating income that you can get over the total cost to build that operating asset? And that yield on cost is directly compared to the cap rate or the exit cap rate. And so long as you have a yield on cost sufficiently higher than the exit cap rate, you essentially have a profitable project. And you just have to remember that the total cost in that equation includes what the developer has purchased the land for. And so what I basically did in this whole exercise with this larger scale development was basically look at what would somebody be willing to pay me for those entitlements in order to pursue it for the next phase. So because there needs to be enough meat on the bone left after I've secured the entitlements for them to actually get there. So that became the big equation that we were working with to figure out that we could buy it for $30,000 a unit and sell it for $85,000 a unit, and profit very handsomely in that first phase but still have enough juice where the next developer would then build it out in its entirety. So that's kind of an insight.
So we have the raw land, then we have the entitled land, then we have the construction of the project, and then we have either the sale or the long-term hold of whatever income property is on that land.
Right. And what I love about starting at the entitlement phase is that there's so many different exit strategies along that process, along that continuum. So in this last 18 months, I've had 3 successful exits of entitlement sites, partly to prove to the people who I've been teaching and even the people who are listening here that you can exit from an entitlement, and that is a very legitimate and can be potentially more lucrative on a relative basis, right? Like your IRR or your relative percentage return can be much higher in that phase, partly because it's going to cost you a lot less to get those approvals compared to building a $10 million project. You may have spent a couple $100,000 on the approvals, whereas the building then to build it just requires a lot more absolute dollars to get there. And then, taking it through the process, building it, and either selling it as a vacant building before you lease it up, selling it after you've leased it up, or selling them on an individual unit basis. So essentially, condoizing the multi-unit project that you get approved as another alternative option. And I usually only want to do projects where condo sales are at an option B. I would much rather build, lease up, refinance out the total cost and hold the asset long term, because in my mind that's really the path to wealth creation, where you're not triggering a tax event and you're retaining the equity and then the long-term cash flow along the way, as opposed to selling off and even taking on more risk by selling off the individual units, because you got to create the HOA and then you have a lot of consumers to deal with. And so, I love the optionality that's baked into the process. as
And
long, yeah, go ahead.
and what it also does is it creates an opportunity to, as a developer, to get in and get investors a really great return. But in the end, if the project is done right, a developer can go through the process and have very little of their own cash into the project when it's all said and done, but still retain some pretty decent ownership in whatever the project is that has been completed.
Absolutely. And that's what I'm endeavoring to do, is to still provide, a very strong return to my investors. And oftentimes they're passive investors. And so essentially cashing them out, giving them a return, that, borders on 20% return for going along in that sort of equity partnership to get there. But then me retaining the asset in the long term, and maybe giving them even a potentially a minority interest in the cash flows that are generated in the long term as well.
Yeah. So it's really combining as many as 4 or 5 strategies together. I mean, it's buying the raw land, and it's getting it entitled or into paper lots. Some people call it paper lots, where it has all the approvals. Then it's the horizontal development, or developing the infrastructure of the land. And then it's getting it to the construction stages, and then either selling or renting out. So it's really combining those strategies, which makes it a very powerful strategy in overall.
Totally. I mean, and if you can create some of the initial value through that entitlement process, many developers would actually see that as de-risking the opportunity, right? Because especially the larger scale developers who are building 100+ unit projects, who have that level of construction experience, they don't really want to deal with the local politics. They'd almost rather, have a more predictable return on their investment, because the project is already approved and they're just putting money down to then build it out themselves. So, what I've been teaching folks is that you can actually secure the entitlements and then contribute the equity that you've created along the way into a larger partnership with somebody with more experience, to then kind of go along for the ride, where you can essentially build larger projects down the road. And I'm still going through that process now, and continue to debate with myself, how much control do I want to give up? Because oftentimes it is a trade-off. If you want to build quicker and bigger, oftentimes you have to give up control to then ride somebody else's coattails, or you can kind of start or kind of grow incrementally to get that experience, but it's going to take a little while to get there, maybe even a couple cycles.
One of the things that I did when I was developing land was to use option property as a way to really mitigate and or reduce risks to the point where it's very, very manageable. What were your ways of keeping the risk low on your deals, your first deals, or in general?
Well, in a seller's market and stuff that's marketed on the market, where people are getting multiple offers, you don't typically have that flexibility, unfortunately, which is really why I teach people to actually market to property owners off market, where they're essentially creating the terms because you're the buyer and they're the seller. And there's not, as a competitive situation. But so in most of the projects that I've done in the past, a year or two, we've closed on the land and before the entitlement. So we did take on a greater risk in doing so, because essentially we were sitting on a vacant gas station that wasn't generating hardly any income. And we took on hard money to actually acquire the site, because only a particular type of lender would be even willing to allow you to close on essentially a raw piece of land. But, I have pulled off strategies where I'm getting into contract with a zoning contingency, which is, one of those beautiful sort of options that you can factor into a project, where you can actually go through the entitlement process before you have to close. which I love. And it's another great way, as you're describing with options, to de-risk the proposition of going through the approval process, especially if you're in a city that, the timing associated with those approvals is rather unknown or, highly unpredictable. And so in doing that, though, you do typically have to offer more money to the seller for that flexibility.
Yeah.
But in my mind, if you don't have to use hard money, for example, to actually close and pay double-digit interests over that period of time and not have to be stuck with it if everything falls apart, it's actually better to offer them more money than take more risk and take on high risk debt in order to pull it off. Options are a great way to do it, though, too.
Yeah, and it's all about risk and reward, right? So
Absolutely.
if we're able to reduce the risk, I always look at it, but if I can reduce the risk, and if I reduce the risk, I'm fine with increasing the return to whoever that risk is being shifted to.
Absolutely.
So for instance, a seller of a property, if they're looking for top dollar on the property, and maybe it is even a hot market, they're looking for top dollar, there still would be the option of offering them to participate as one of the owners of the property as it's being developed, because they're going to be able to see the upside as well. So
Right.
we can reduce our risk by not putting as much capital into it up front, sharing the risk with the landowner, but then being willing to share with them the profits or the upside, the potential at the same time.
Absolutely. Yeah, partnerships are a great way to basically give them credit for the current value as it currently stands. And then basically say, as you're saying, split the share of the upsides after the entitlements, and explaining to them that, look, you're going to finance the approvals. They are not going to have, and they can potentially keep all of the cash flow that the property is currently generating to service whatever debt that they might have, or continue to have business as usual, and then participate in the upside. It becomes just a negotiation then as to what those splits would look like. So you would have to essentially forego some of the opportunity, but again, that proposition on a risk reward basis might actually be a lot better. The one thing to keep in mind is that when you have these sorts of flexible arrangements, oftentimes you have to spend the money unsecured, meaning that you're not putting a lien against the property. You can, and I think that's a highly advisable way to do it, but it's not, you can't take on debt really as you would traditionally with like a fix and flip to then navigate the approval. So it's really then a matter of tapping into equity sources of capital and getting your investors aware enough that you know what you're doing and that that this is a good investment. And so it really makes sense to work with an attorney to make sure that all of your I's and T's are crossed. So yeah.
Yeah, and this will probably be discussion for another show, but one of the things that we do when we create an option with a landowner is we can structure it in a way that there are milestones within that process, and so it could be set so that as each milestone is hit, it triggers another option to that next level.
Right.
And what's really nice about that is it keeps that landowner's interest. I mean, they're very, a lot of times they're willing to do it if it's explained properly, because they're getting an increase in value for every bit of work that you do as a developer on that property. And so staging it up each time with value and maybe an additional deposit on lease option or whatever it might be. So there are a lot of different ways, creative ways to structure it so that the risk is maintained at a low level.
Right.
We'll be sharing in the profits, but that's totally fine because the risk is being shared as well.
Absolutely. And the key milestones that you're alluding to, in my mind, would be, once you've decided to commit after the due diligence period, and then obtaining the zoning approval letter. And that's simply just getting out of the zoning department. You have an approval letter that says you can build it.
Yeah.
And oftentimes that would be in a zoning contingency what you close after. Or you could go to the next phase, in my mind, which would be getting the building permits in hand. And if your intention is to actually build it, I would suggest to everybody that they not tie it to the zoning approval, because lenders typically won't lend you the money to build it until you actually have the building permits in hand. The building permit process, in my experience, is much shorter than the zoning approval process, because you've kind of finished the public process, the public notification.
And the public notification is one of the riskiest parts, because it's the difference between discretionary and non-discretionary decisions. And so again, That's probably for one of our next shows. This has been great information.
Yeah, definitely.
Now, if people want to reach out to you, if they have questions, or if they want to connect with you, how would they be able to reach you?
So, I've really seen a need in the market for more real estate professionals, even, or anybody for that matter, to understand the development process and actually be empowered to navigate it themselves to essentially make our cities better. I'm a big proponent for the smart growth development of cities. And so I've created a whole developer academy that I've now taken tens of people through, and have really empowered people to understand how to identify development opportunities, how to analyze the development potential, and how to secure the opportunities to actually create value through the development process. And so the www.smartgrowthdeveloperacademy.com is the site where people can go and see this essentially 8-week program where I'm guiding them through. They're hearing from all of my development team, seeing all the case studies that I've done, and really getting into the nitty-gritty of how to actually execute on these strategies that I've been talking about today. People can also find me on my meetup group here in the Bay Area, the Smart Growth Real Estate Meetup. I also have a podcast myself, the Smart Growth Developer Spotlight, on iTunes, and social media. So at Chris A. Porto is where people can find me there.
Excellent. And we'll have all of these in the show notes, all of the links. So
and in addition to a video training series that I've just put together, I'll send you the link to that so that your show listeners can go through that and get a deeper feel as to what's involved in this whole process.
Okay, great. So Chris, you get the last word on the show. What is the one key point people need to remember from everything we've talked about?
I would say that people should realize that they are more powerful than they think. We're all basically given a right to create in the world. And in real estate development in particular, you're essentially enabled to create realities, create whole worlds for people to live, work, and play within. And so I would highly encourage people to realize that even if they don't feel called to doing this full time, it behooves them to gain this knowledge of how to actually develop real estate from nothing, and essentially tee up opportunities to create realities for people to live more fulfilling lives. And I really feel called to empowering people with this sort of knowledge to be able to contribute to the collective development.